Hello and welcome to the Mutual Fund Show. My name is Neeraj Shah, and over the next 25 minutes or 30 minutes, we'll talk all about mutual funds. This show, we're getting two experts to talk about the 4 or 5 most pressing issues to our mind, or pressing, or not really an issue, but a topic at this current point of time. And to talk about that, Amol Joshi, founder at PlanRupee Investment Services, and Vishal Doshi, partner at Alpha Investment Services, join us on the show. Chairman, both of you, thank you so much for taking the time.
Pleasure to be here, Neeraj.
Pleasure.
Thank you. So, let's start off and get straight off the bat is arguably the biggest question. Debt schemes. It's been there now for a while.
Right.
Recent conversations seem to suggest that maybe, just maybe, the pressures might be easing a bit. And therefore, would it be a good idea to go out and make some investments in some debt funds or credit risk funds?
Right.
Because the returns are very high and maybe the market is overly fearful. We are also on the cusp of the credit policy. Sure. So, what are your views on those? Amol, let's start off with you.
Neeraj, I think in one of the previous shows also we discussed that whenever there is fear in market, you have rates or YTMs of mutual funds that have gone up, that have shot through the roof. Whenever there are higher YTMs, in the long run, you are likely to make more returns. This is not to say that there is no credit risk. In a credit fund, you obviously run the credit risk, but that was same 1 year back when there was no credit event. That was same 5 years back when there was probably no credit event. Having said that, with you also alluded to the RBI policy, which is due shortly. Considering higher YTMs, the chances of rate cut, I think debt fund investment remains as strong an investment proposition as it always was.
Okay, so the yield to maturities of the YTMs looking fairly interesting, and therefore Amol Joshi believes that they are as interesting an investment as they have ever been. Vishal, I mean, the skeptic would argue that maybe, just maybe, if in perception, if not in reality, the risk when these whole events happen was a bit more, and maybe that's why the returns were higher. The question is now the return slightly more appropriate than the quantum of risk, if any, that these schemes propose? What would your advice be?
Yes, Neeraj, I think the risk-reward, as we perceive in the financial markets, the risk-reward ratio, I think is now probably tilting in favor of the reward side. As Amol rightly pointed out, the difference, I would just put one point, the difference between the repo rate and the YTMs of many of the accrual schemes have now started looking attractive. So I think in the past, whenever this kind of difference has occurred, the investors have made double-digit kind of returns. So I think probably it is time investors should start looking at accrual funds or credit risk funds, so to speak.
There's a school of thought, and I would want both of you to comment on this, but Vishal, there's a school of thought which says that if I want to take risks, I'll take it with the equity funds. Why do I need to take risk with a non-equity fund? And if there is even the slightest of risk here, let me not go for that. I'll invest in equities and take that risk. Let me go in for the safest product in the mutual fund space if I want to do a non-equity product.
Sure, but equities obviously have a different kind of risk profile, right, compared to a debt scheme. So when you invest in an equity scheme, you are investing for probably 2x growth, or some larger returns, at least 15% or maybe 20% kind of returns. So debt naturally is not that kind of a product. So investors who are coming on the debt side, they have a set view that we have to have a principal protected, and we are looking for a certain kind of return profile. So I think both the schemes are probably not comparable, so to speak.
Yeah, that's true. I was just wondering if indeed from a risk
I have a view here in what you said. So again, this school of thought is also right when somebody says that if I have to take risk, I might as well go to equities and probably have a much better reward at the end of the day after my investment horizon is done. However, in that we are ignoring one point, that based on your risk profile, if you do not want to take credit risk, there are other products in debt as well. So you can start right from, and again, I think we have discussed this earlier as well, you have liquid funds where, in my opinion, you will have very less chances of something going wrong.
But Amol, no, the larger question was that should one invest in these funds which are giving this,
So I would say in credit funds, we have to look at some calculations. So these days, credit funds, earlier some of the credit funds had a 5%, 7% exposure to one singular security. That if that security goes bad, you would probably be looking at a much bigger dent. These days, I know some funds that have around 70, 80 securities. So the average holding is not more than 1.5%. Even if you lose 25% of that 1% security, your overall hit in that portfolio or in that scheme is restricted at 0.25%. Okay. And most of debt investors who come to a long duration or medium duration schemes, those investors will stay for 3 years, because at the end of 3 years, you get a huge benefit called indexation via taxation. Over 3 years, this 25 paisa cut is hardly anything. It will, yeah. So based on that also, the risk reward matrix, as rightly pointed out, probably is looking attractive at this stage. And certainly, we have seen some of the names that face trouble. Those names have been able to repay all their maturities. So that's something that cannot be ignored. Whenever times were bad, we looked at it with caution. Whenever there is whenever the repayments have happened on time properly, I think the credit goes to the fund manager for selecting a right credit over there.
Okay, so the best or one of the better investments within this category. Where is the risk reward high, and with the risk being measurable and not out of whack?
In terms of scheme name, you are saying?
Yes, please.
A particular scheme that comes to my mind is Franklin India Short-Term Fund. This fund has done consistently well. It had one of the papers, but I think that was around 3 years back or probably more. After that, the fund concentration in each security has drastically reduced. Fund size is, decently large enough to take care of liquidity redemptions. The fund also followed something called as auto liquidation of papers, in the sense you have papers that mature at a regular interval, so that it automatically generates liquidity. As well as Franklin Templeton has shown one of the better credit evaluation expertise in all their funds and in everything that they do. Okay. So that would be my pick.
Okay, Vishal.
ICICI has a very good accrual fund, which I think investors should look at.
And the returns would be?
Returns, they have done fairly well in the last 6 months, and I think the YTMs of the scheme is currently very good. So I think probably investors can look at that scheme for double-digit kind of returns. Okay,
so keep this in the back of your mind. Don't be overly fearful of the debt schemes, is what our experts are saying. Now, post the new government coming in, the biggest theme has been infrastructure. Right. Vishal, I want to start this conversation with you. Sure. Should people invest in infrastructure funds?
Yes, people should invest in infrastructure funds, but with a longer horizon. What has happened is probably earlier when the NDA one came, I think in 2014 itself, the infra funds gave probably 50-60% kind of returns in 1 year. So investors are getting excited probably even now that NDA has come back, and maybe we can see that kind of returns. But you will have to remember that in 2011 and in 2013, infra funds gave negative returns. So the base for 2014 was very low for these funds to start with. But now in the last 5 years, in the first NDA government, these funds are given returns anywhere between 10 to 18% CAGR. So I think the base is now not so low. So funds will do well, but not like 2014 kind of scenario where we saw 50% returns in 1 year time. But definitely investors should look at infra funds because the government has got a clear focus on this sector. Okay. So these funds are bound to do well.
Okay, so Vishal recommending that it might not be a bad idea to look at infrastructure funds. I'm presuming hand to hand when this advice goes, the belief that you should be knowing about the fund and the infrastructure space very well before you go out and invest in the thematic fund. Amol, does your view differ? And it's okay if it differs, by the way.
Of course. And again, I have this long-held view that sectoral funds being at the extreme end of risk and return matrix, you probably run the highest risk because everybody knows sectors can be affected by one single government policy. Sectors can be affected by a technological disruption, which nobody sees coming. Sectors can be affected based on how the political outcomes on the other end of the world are. Something that IT companies have seen a couple of years, 2-3 years back. Having said that, since equities are always unpredictable, you do not want to add one more risk to that entire mix. And that's why I have always maintained, unless you are actually an expert, you have your own view, you have your own understanding of the sector, probably the future, what future holds for that sector, as well as perspective on valuations. Like another point was made that currently these funds have given 15 to 18% CAGR. So you are probably looking at this entire space currently is highly valued in terms of the valuations are rich. So my view is infrastructure or any sectoral funds, you should go only when you know what you are doing, only when you are comfortable with valuations. Else, a normal investor is always best served with diversified funds. Fund manager is much better equipped to take sectoral calls than an individual investor.
Okay, so that's the view on infrastructure funds. The next view is on banking, of course. And Amol, again, the question, what does one do with funds which have got a higher proportion to banking, or are those thematic funds? Because everybody seems to believe that over the next 5 years, whatever does well or no is one thing, but banking will certainly do well.
Right, of course. So that again remains, when the economy does, for a stock market to do well over medium to long term, obviously we are not talking about short term, over medium to long term, if stocks have to do well, banking has to be a part of that entire growth story, number one. Number two, banking as such is about 1/3 of the weightage in terms of how the index is currently in the index composition. When all those things are there, that makes banking slightly different. Now, I would like to connect very quickly this question with the previous question. There were certain infrastructure funds which held banking stocks as well, because banks lent to those particular infrastructure projects. So banking is a sector which is all you will have banking almost at every sector that you look at, and since it forms 35% of the market currently in terms of market capitalization or the index composition, I'm sorry, I would still say that in diversified funds you have funds that have maintained banking anywhere from 25 to 40%. Now that's as large an allocation that you can hope for, and hence diversification again diversified funds again makes sense.
So maybe not banking funds.
Maybe not banking funds directly. So it's largely a repetition of my answer on the first question.
Yeah, but are there, I mean, just wondering if there are some banking funds which you have tracked which you think are good enough?
Of course, I do track funds, and ICICI Prudential Banking and Financial Services Fund, that fund has done really well. So if you have a view on banking, if you are comfortable with valuations, and if you are allocating it only as a proportion. So when I said that a lay investor is best served with diversified, because diversified will have all the sectors. If you are building a portfolio and if you want to go towards banking, and if it is restricted towards 5, 10, 15% of your portfolio, then sector won't do you much harm in case your call goes wrong. If that is the perspective, then this is one fund that you can look at.
Okay, so do watch out for those names as well, Amol Joshi. But you heard his rationale about what he's recommending when it comes to banking funds. Vishal, do you differ there? And again, as I say, it's always okay to differ. People get both views.
Yeah, I think so. Banking as a sector, as Amol rightly pointed out, is probably the backbone of our economy. And as the economy grows, the sector is bound to grow. But I would like to make a point here that as the popular adage goes, like when there's blood on the street, probably that is the time you want to invest. So this is a sector which has seen all kinds of troubles in the last 1 or 2 years, right? From the NPA mess that was created, and now the NBFC crisis that we've seen. But as things move on, I think the sector has only grown in proportion. Now investors have a choice, as either they invest in diversified mutual funds where there are 20-30% of the portion is already in banking stocks, largely probably in private sector banks, or they can go for specialized banking funds. So I think investors can probably go for these banking funds, because I think there are 2-3 things which are happening. One is the government is trying to cure the NBFC liquidity crisis. In the PSU space, the government is trying to do merger of various PSU banks, and probably capital infusion is happening. So I think these 2-3 steps, plus the economy is slowing down, so the government is looking to rev up the economy. So I think all this is going to help the banking sector. So there are, I think, 2 or 3 good funds in the banking space which investors can look at.
Okay, I think ICICI Pru is one of the names, and I think the names will come up on your screen, viewers. But ICICI Pru is one, and the Aditya Birla Sun Life Banking and Financial Services Fund.
Absolutely.
These are the 2 that you're recommending?
Yes, absolutely.
Okay, a small proportion of the portfolio.
Small proportion of the portfolio can be invested in these funds.
Okay, so well, that's with regards to debt funds, infrastructure, banking funds. Now, what we thought of doing that, because the last 3 months have been very active and volatile for the markets, let's try and figure out which are the best funds in the 3 categories, large, mid, small, and which are the worst funds in the large, mid, small category. Not to tell that if they have done this well or done this badly over the last 3 months, they'll continue doing that. But try and figure out, because a lot of people sort by the gains and the losses that people have done. Let's ask our experts, what do they think of some of those funds? Now, we'll send the list to both of you. Vishal, if I can start off this conversation with you. From the best performing funds category across large, mid, small, etc., are there any funds which have done well in the last 3 months, but you believe that they are generally good performers and therefore people can invest in them irrespective of what they've done in the last 3 months?
Sure. So I think a couple of names come to my mind, which is HDFC Top 100 is probably a fund which has done well and is probably likely to continue to do well given how the portfolio is. Then there are other funds also from the mid cap and the small cap space. ICICI has got a small cap fund which is doing reasonably okay now. In the mid cap space also there are a couple of funds which are continuing to do well. So I think investors are probably okay to hold on to these funds. As the market probably grows, I think these funds are bound to do well.
Okay, so hold the BNP Paribas Mid Cap Fund, maybe the Mahindra Unnati Engineering Business Yojana Fund. That's in the mid cap space, and in the small cap space again hold the ICICI Prudential Small Cap and the L&T Emerging Businesses funds. Remember, these have done very well. Vishal believes you should hold them. Just a quick follow up.
Sure.
In the funds which have done well, I think you have a sell call or get out of the fund call on one of those names. This should come up on your screen in the large cap category. The DSP Nifty Next 50 Index Fund.
Yeah, it is an index fund for the next 50 index. I'm not so comfortable with that index composition because I think around 40% of the composition is in sectors which are not doing so well as of now, which are probably lagging, which are showing trends of degrowth. So I'm not so comfortable holding that kind of fund.
Okay, Amol, what about you within the well-performing funds category, large, mid, small?
Right. So within the well-performing funds, I will again take the name specifically for HDFC Top 100. So now, whenever a fund performs, you always should know the story or the reason behind the fund performance. Now, the fund manager of this particular fund has always been very, very active in communicating that we work ahead of the cycle. So before the maturity for a particular sector, for a particular large company takes place, we take the profits much before that maturity and we get into the sectors that are looking up now. One of such calls that was taken for corporate banks that have a major lending to corporates. So based on that, this fund is probably doing well. If you believe that such a fund or such a strategy sits right with how you would want your fund to manage your money, I think that would be well in terms of you can stay with that fund. Other point was some of the mid-cap names that have not done well. But now with last few days, I'm not sure this data is from month end to month end or 5th to 5th or 30th to 30th, I'm not sure. Having said that, in mid-caps and small caps,
okay, we're moving on to the funds which have not done well now.
Yes.
Okay.
In mid caps and small caps, you simply cannot have, and you have made that point clear earlier as well. 3 months is not the right time window to look at. But having said that, if you have taken a 3-year to 5-year view, or if you have a more than 5-year view, then mid caps and small caps certainly can be taken exposure to, especially via SIPs or STPs. One important point is compared to 2018 Jan, just before the scheme categorization and the budget of last year took place, you had a maximum divergence between the mid-cap valuations and large-cap valuations. Now that the large-cap valuations have gone up and mid-cap valuations have come down, mid-cap in fact looks slightly better placed than large cap if you have a 5-year plus sort of a horizon. So you can continue, especially if you take exposure via systematic way, SIPs or STPs.
Okay, Vishal, what about those categories, the ones which haven't done well? People might look at those names and say, oh, these funds are not good, but maybe some of them are good, just running a slightly poor cycle. What are your views on any of those names if you kind of have a view there?
I think those funds can be held on to because what is happening, as Amol pointed out, that the difference between the large caps and the mid caps, the valuation gap is increased substantially. And as we all understand, the market has been moving by probably 10 stocks, which is pushing the index up. So I think those stocks, there is nothing wrong in the portfolio as such. It is just that the market is now in such a zone that 10-15 stocks are just pushing the index. So nothing wrong in holding those funds, and probably investors can continue to hold those funds.
Okay. Now, the final piece on this conversation today, remember last week we had gotten the DSP team out here to talk about, amongst other things, their new fund offer to DSP Quant Fund. From what I understood, a one-of-a-kind fund. It's not something that comes too often. It is direct in nature, expenses are lower, etc. The question is, should you go out and invest money in such a fund? Amol, I want to start off this conversation with you. The NFO ended yesterday.
Yes.
So people who wanted to invest would have invested.
Yes.
For people who haven't invested, but read about this fund, hear about it, see the ads, and want to know if they should invest or no, what is your view and why?
Right. So again, as I said in previous answer, if a fund is doing well, you should know what is the story. Similarly, this is a new fund, so you should know what is the story before you go out and put your money into it. So this is a quant fund. Quant fund works on certain rules, certain mathematical algorithms, let's say. So this fund first and foremost wants to not invest into companies that are not doing very well in terms of return on equity, in terms of corporate governance, in terms of various parameters that the fund has selected. That's number one. Number two, this fund intends to have a very, very low churn, very, very less churn to keep the expenses down. Last but not the least, the fund has categorically tried to communicate that we want investors with preferably with 5 years or more horizon. So if you are looking at investing into this fund, if you are at a crossroad whether to invest or not, please see, one more point. The fund has again communicated that in a one-way sort of a market, which is driven by a liquidity rally, which is driven by something which, which is not really valuations, then this fund will not do well. And that's the reason why you should have an extended time horizon, time period. If your view is 2 years, 3 years, anything less than 5 years, you should not look at it. However, if you believe that quant funds or a fund that works on certain rules or algorithms or certain computer models, if you think that this is the way to go, you can allocate a certain portion.
What do you believe?
Okay, so I would say that actively managed funds. So quant fund, the rebalancing is once in 6 months. I would say that to my comfort, this is probably much longer. I would want something which which has an evolving view on the market. 6 months is probably something too long. So if you were sitting in April last year, you just had a budget in which you had a long-term capital gain tax, and before a completion of 3 months, you had scheme recategorization, in which a lot of mid-cap and mid-cap and small caps were sold from, other. So you will miss this entire event.
Would it be cast in stone? I'm sure they can change the rules, right?
Yeah.
As of now, in NFO, the fund says that it will rebalance only once in 6 months. So based on what information is available currently, but I don't think so, because NFO has closed yesterday. So if you put money yesterday and you like that strategy, if they change it tomorrow, that's not going to. So I don't think this will be changed, although there will be an option, but I don't think fund or team would want to change it so quickly, because that will not be a great point on conviction. So they're not likely to do that.
Not comfortable investing in it. Actively managed funds might be better, right?
Yes, that's
okay. Running slightly short of time, but Vishal, your call on this.
I think one of the interesting point of this fund is that it removes stocks which are not doing well, right? Which are basically they call alpha destroyers. So they have a BSE 200 as their benchmark. So when they run their model, I think 99 stocks got eliminated, which are stocks which are either highly leveraged or stocks which exhibit high volatility or high beta, and stocks which have management issues, etc. So now we've got only 100 stocks left out of BSE 200. Now again, they've got a set of rules to choose 50 stocks out of that, and those rules are pretty interesting, where they are looking for stocks which have shown consistently high ROEs, high earnings growth, etc., and probably good dividend yields and free cash flow yields. So which is precisely what an investor would want, right, in his portfolio, that these are the stocks which are doing very well. And but the point is that the investor has to be ready to sit in this fund across market cycle, which I think is probably the key point over here. And the market cycle may probably last 7 years in India. So if an investor has that kind of horizon, only then I think it makes sense for him to enter this fund. Because in the end, these funds don't really have an history in India. Probably there's only one quant fund in India, which is the Reliance Quant Fund. And that again has a different set of rules. So that will perform differently than this quant fund. So investors should have that kind of horizon if they want to invest in this fund.
Okay. Gentlemen, really appreciate your time today. Thank you so much for being with us on the Mutual Fund Show and giving us your advice. And viewers, I hope you benefited from this. Lots of questions answered, some names of funds which our experts believe are good. If you want to write to them asking about today's show, please do on our social media handles and we'll get them to answer these questions as well. But it's a wrap on this leg of the Mutual Fund Show. Stay tuned to Bloomberg Win.